Good afternoon, everyone. This is Bob Bethel with the Employers Association, and I am not literally here with Bob Bobek from Gilmore, Jason, Mahler, but we're together, as so many of us have been over the last few weeks, via in this case, a GoToWebinar presentation. And we're here today, and primarily Bob is here to talk today about the SBA's application for loan forgiveness, what recipients need to know. And so this is something that we wanted to be able to present to not only our members, but to businesses throughout Northwest Ohio. Many of you are, I'm sure, either members of the Employers Association or of clients of Gilmore, Jason, Mahler. So we welcome you to this, and I'm sure that Bob is going to share a lot of good information with you about this, which is sort of the latest on where we are right now. We did a webinar a few weeks ago on the payroll protection program, basically how to apply for it and what was in the CARES Act and those kind of things. Now we're moving into that next reality that we have, trying to figure out the details of how you make sure that you get the loan forgiveness on this. So with that, I'm going to turn it over to Bob. Bob is a partner with Gilmore Jason. He has over 35 years of experience as a CPA, and so he's going to give us all this, and I'm going to get off of here and let Bob take it from here. So thanks, Bob, for doing this.
Thank you, Bob, and thank you for everyone joining in. As Bob mentioned, we last did a presentation on this topic right after the CARES Act was passed, and that happened on March 27th. So that was nearly 2 months ago. And again, just to remind everyone what the CARES Act was for, was to provide liquidity into our economy. And the game plan to provide that liquidity into the economy was a brand new program called the Paycheck Protection Program, where they were going to use the current SBA group of lenders to allow companies with less than 500 employees to borrow based upon 2.5 months of payroll. And if they spent that money quickly over an 8-week period, pushing it back out into our economy, that portion of the loan will be forgiven. So we're at that point in time to talk about forgiveness. And so the other thing that happened too was the first round of money really got used up fast. So the first applications were accepted on, I think, April 3rd or 4th. It was a Friday. And by April 16th, the total allocated amount of $348 billion was used up, and the program was shut down. Then on April 24th, a new law was signed, and the funding again started up on April 27th for a second round of $310 billion for the PPP program. And also in the first round, there was an existing program that's been around for years, the Economic Injury Disaster Loan. And before they came out with the PPP, there was a lot of companies applying for these economic injury disaster loans. And so during that first round, all the money allocated to that program was used up. So again, in the second act, the coronavirus relief bill, Congress added another $50 billion to the economic injury disaster loans and $10 billion in economic injury disaster loan grants. And we're going to talk about that a little bit briefly today, because those programs are still out there available for your use. So again, the Paycheck Protection Program is the key part of this act. What they're using are all the lending institutions out there in the country to allow companies to apply, not-for-profits and companies to apply through their bank for a PPP loan. And it was a very streamlined process, 2 pages of questions to answer. You put in the total amount of your payroll costs as defined in the Act, multiplied times 2.5, and that was the maximum amount of your loan. As we said earlier, round 1 was used up by April 16th, and that was $348 billion. And round 2 is still available through the 23rd. There was about $150 million available still of the 310. So the use of the program is greatly slowed down. Here are the statistics from the program. This is through last Friday. SBA publishes this every Friday. There are a total of 4.4 million loans out there for 511 billion, and there's 5,511 financial institutions, banks, and various other lenders involved in the program. Some more information on the lenders. The next key slide here I always look at is by states. Ohio is towards the bottom of that middle page or middle column, and we're the 7th largest with 18 billion in loans provided to companies within the state of Ohio. And here's the last key slide by loan size. As you can see, the average loan is 116,000. And we're going to talk about this later, but there's a key cutoff point of $2 million. And so that's about 21% of the loans in dollar amount or over the 2 million, but it's less than 1% or 0.7% of the loans. And when you do the math on that, that's about 310,000 loans or greater than the $2 million, which is the key cutoff number, which we're going to talk about later in this presentation. And then here are the top 15 PP lenders. They don't list the names, but as you can see, there's some rather large institutions, the first 5, and then it starts trailing off. So back to the basics of the PPP program. The maximum loan is $10 million. Guidance came out that the amount of the loan that's not forgiven will have a 2-year amortization period and would be charged 1% interest. You're allowed to use the loans to fund payroll costs, group health insurance, retirement costs, interest on mortgage payments, rent, utilities, and interest on other debt obligations incurred before the covered period. The covered period cutoff date is February 15th. You'll see that date throughout this presentation. And so various agreements had to be in place before that date. Again, there's been a lot of misinformation out there, but you are not required to disaggregate or put these funds in a separate bank account. A lot of the larger banks, simply because of time and trying to get these loans out, simply deposited the money into your main operating account. That is totally permitted. Part of the program does allow borrowers and others the ability to ask for forgiveness. And there's a recent guidance that came out last Friday, May 22nd. And throughout that guidance, I saw the terminology of maximizing forgiveness. So again, their intentions are, if you're using this money to get it back out to the economy, which was the intent of Congress, to provide liquidity to our economy and get this money out within 8 weeks, back in paychecks and rent payments and utility payments and interest payments on your loans, this money is eligible for forgiveness. And again, it's pretty much the whole idea behind the program was to stop businesses from making their normal decision making when the economy slowed down to lay off a lot of people. Those people will be forced into the to the unemployment office. And in that unemployment office, they would start claiming unemployment benefits and no longer pay state and local taxes. They would not be paying any type of money into the retirement. And also it caused damages throughout the economy. And so then when you went to hire those people back, then it might not be available. So the whole logic behind the program was to allow you to retain your employees, retain your place of business by paying your rent and utilities. So when we get past the shutdown period, you can quickly go back into operation. Now, one of the key things that caused some angst among some borrowers was the certification. And that certification is in every PPP application. You had to confirm that you met this requirement, and it's listed right there. Current economic uncertainty make the loan request necessary to support the ongoing operations of the applicant. So it's a good faith certification of uncertainty. And as we talked to many companies, everyone was facing a substantial amount of uncertainty. But what happened was when the program was first announced, there were some large publicly traded companies that met the definition of less than 500 employees by location. And that definition was available to companies in 2 niches, industry groups, that would be restaurants and hospitalities. So a lot of the large restaurant chains, publicly traded, maybe have 40,000 employees, had access to the capital markets, can issue bonds and stuff like that. but they asked for $10 million of a loan. It was granted. And what happened was once the press started hearing about this, I remember seeing the interview with the president, and the president said, no, that was not the intentions, and that they would set up some kind of rules to monitor for this. So these are those rules. Okay, so again, you have to make that certification. And recently in some guidance, which some of the guidance has been coming out with Q&As, questions and answers, provided by the SBA, recently said that certain loans, all loans under $2 million will be deemed to meet this definition. So if you have a loan of less than $2 million, you are definitely, they've already self-determined that you met the certification. Loans greater than $2 million are subject to SBA review. So those are those 0.7%, less than 1% of the loans over $2 million are subject to certain SBA review. Now, again, I know in the press they use the audit, but in the regulations, they're talking about some sort of review process done by the SBA. And so one of the questions and answers, number 31 in the Q&A, talked about these loans and this uncertainty. And it was very clear they're targeting public markets. So it stated that a borrower should consider your current business activity and ability to access other sources of liquidity. And it went on to say exactly, it is unlikely that a public company with substantial market value, access to capital markets, will be able to make this required certification. So again, they're targeting these larger companies. I know one of the groups that received a loan and later returned it was the LA Lakers, the basketball team in LA. And again, I think their market value, most NBA market values in the billions of dollars. So again, they have the ability to access these capital markets. So if the SBA comes in, does a review, and determines you didn't meet the definition of the certification, they will seek repayment of loan, and you will not be eligible for forgiveness. In recent guidance that came out last Friday to borrowers, for those that don't meet this definition, it simply converts to a 2-year loan, it looks like, and you get 2 years to pay it back. Again, a later question came up, I think it was number 37 in Q&A, that said, what if, as a borrower, you had access to a line of credit? And the SBA answered that by just referring to the existing guidance in 31, did not add to anything to that. And again, you know, under the PPP loan program, it was in the law that they waived the right that you have no access to other borrowing facilities, such as line of credit. So again, I don't foresee having a line of credit available for use would jeopardize the uncertainty, especially when lines of credits are tied to collateral bases, such as account receivables and inventory. Because unfortunately, a lot of the businesses, no matter what industry they're in, were shut down or really slowed down over the last 60 days. And that's just a natural cycle. What happens when you have a slowdown is your receivables drop. As you collect receivables, you get that money and you no longer have new receivables to support the line of credit. And so a lot of times the ability to use a line of credit just naturally shrinks as your receivables and inventory shrink. And I just had a client call me last week concerned their bank had a discussion with them about their shrinking collateral base and their inability to use a line of credit going forward. So again, this is definitely uncertainty we are all facing. And so we're recommending every company, every not-for-profit, regardless if you're below 2 million or above 2 million, take the time right now to document the uncertainty you were all facing when you apply for your loan. And a lot of the suggested information included in that, if you have forecasts of the future, what your sales are going to look like, what your costs are going to be, there might be some cash burn where your costs are exceeding your sales and you're using up cash depletion, document that. Reductions to slow down collection of account receivables. I think every company or organization is going to be faced with some level of that. Reduction in sales activity or bid opportunities. Supply chain and subcontractor disruptions. Obsolescence or perishable inventory losses, or just growing inventory that's not turning. And then work stoppage or cancellation by customers and local government. We do a lot of work with contractors, and while they had work on the books, their customers or the local government said, no, you are not allowed to come out to perform that work right now. You must defer that for a month or two. So again, we still see a lot of work stoppage in the last couple of months. So again, as the economy turns back on, which is slowly starting to do now, there's going to be this regrowth of businesses and building their balance sheets back up. So what is the forgiveness period? The forgiveness period is the 8 weeks after the loan origination. And the loan origination is the day you got the money deposited in your bank account. And you're eligible for 2 types of forgiveness and 2 types of costs, payroll cost and non-payroll costs. And on May 15th, that was about 2 weeks ago, the SBA released its application for how you submit for loan forgiveness. And there's a link there to the website on how you would go about processing or requesting a loan forgiveness. So what costs are eligible for forgiveness? So it's defined in this recent guidance, this new terminology of paid or incurred during the 8-week consecutive period started at the beginning of your 8-week covered period are eligible for forgiveness. So money you spend in these 2 areas. Usually prepayment of expenses beyond your 8-week forgiveness period is not permitted. So you're not allowed to pay, let's say your forgiveness period ends on July 31st. You can't prepay for August or September utility bills or anything like that. Again, recent guidance was just issued last Friday. And there's 2 key areas that I know a lot of companies have asked us about and we're trying to answer. It's very clear in the guidance that they probably provided good answers here to this. The first one are salary or wages or commissions paid for furloughed employees, those that are your pay but not coming to work, bonuses or hazard pay during the covered period are eligible for forgiveness. So we've always said that there's no prohibition against increasing someone's pay and through a bonus or hazard pay. And so this has been agreed to by the SBA and in their guidance. They did put one other item in this guidance that's a new wrinkle to the program, and that is on owner's salary, the owners of the company's salary. There's always been a $100,000 cap on anyone's salary, and that cap also exists on owner's salary, which is $15,385. But there's now a look back. And if the owner's salary was less than $100,000 in 2019, you're only allowed to use 8 weeks of that average salary. Okay, or about 15.38% of whatever was on that W-2. It was less than 100,000. So it did cap that if you're trying to give an owner an increase during this 8-week period and they weren't making more than 100,000 last year, you're probably not going to be able to get that increase as part of the forgiveness amount. So what are payroll costs? It's the same payroll cost calculation you did to draw down your loan. It's salary, wages, commission, vacation, sick pay, not to exceed 100,000 per employee. You also get to include 100,000 for self-employed individuals. Those are individuals that get Schedule Cs or guaranteed payments to LLCs. So like a member of an LLC does not get a W-2, but they get a guaranteed payment. So for the 8 weeks, the maximum wages or compensation you can count for any one employee for forgiveness is $15,385. Once you have that, you add to it your group health insurance cost. And if you're part of a union agreement, that would be the health and welfare benefits. You can also include self-insurance and other types of health insurance benefits. You got retirement benefit costs. And again, if you're part of a union retirement plan, you get to include their pension benefits, just their pension benefits. And there'll be state and local taxes on employees' comp, but right now in the state of Ohio, we only have 2. Those would be the state unemployment and then the workers' comp. Now, the thing with workers' comp is I know workers' comp has deferred payments for 3 months, I think March, April, May. And they've also announced a large rebate. And as part of that rebate, they're going to remove your required payments that you should have been making So it's literally you're not going to be making these payments. And so a key ingredient, as we're going to see coming up, is paid and incurred. And for any expenses you're claiming, you're going to have to demonstrate you actually wrote a check to pay it. So there might be some elimination there, inability to claim that workers' comp. So to make it simple, because they know people's payroll periods didn't quite align with the covered period. So you might have closed your loan on a Wednesday and your payroll starts on Mondays. So they have created an alternate payroll covered period. And we're going to explain that shortly, but all these costs, if you use that methodology, you must measure these costs under that same methodology, the alternate payroll period. So what this does is allow you to line your covered period with your actual payroll schedule. So instead of starting the 8 weeks for the payroll piece on the day you receive your proceeds, you can start with the first payroll for the first day of the company's first payroll period following their PPP loan disbursement. So your first payroll after you received your receipts of PPP loans could start your 8-week period for payroll. And again, if this extends a little farther than the 8-week period, you get a full 8 payrolls in there, or 8 weeks of payroll. So the example in the guidance is this example here, where you got your loan proceeds on April 20th, but your first payroll after that is April 26th. So you can start your 8-week on the April 26th, and that will take you, the 8-week period would now be June 20th. If you would leave it at the original April 20th, your 8 weeks would have ended a week earlier on June 13th. So again, if you decide to use the alternate methodology of measuring payroll for 8 weeks, you have to do that for all the payroll costs that we just spoke about. So here's an example of the items to add up for forgiveness on payroll costs. So salary and wages for all your employees for less than $100,000 per employee for the 8 weeks. The group health insurance and unit benefits you paid for those 8 weeks. Retirement benefits you paid for those 8 weeks. State and local taxes. So in this example, the grand total is $525,000. And in this case, if you had a member, let's say instead of getting a W-2, their dollar amount would go on that last line, earning from self-employment. That would be for members or sole proprietors. So the next piece of it is your non-payroll cost. So under the Act, they do allow you to claim 3 different distinct areas beyond payroll costs for forgiveness. However, these costs cannot exceed more than 25% of the total amount forgiven. So basically, it's the lesser of the amount paid or the 25% of the total amount forgiven, which we'll demonstrate that calculation shortly. So there's 3 pots here. The first one's rent, the next one's utilities, and the last one is a pot that they call mortgage interest. The one that the one guidance that came out that's really interesting in this May 22nd guidance is this logic of paid or incurred during the covered period. So again, it could entitle you to take more than 8 weeks of utility costs, and I'll demonstrate that shortly how that would work. And in reading the guidance, they felt like this was necessary because they already had a cap on the maximum amount you were going to get forgiven for these 3 pots at 25%. So they weren't really going to kind of get into debate over, exactly 8 weeks of these costs. So again, talking about the paid or incurred during the covered period. And then if it goes beyond that, you get to include any amounts up to the end of the covered period, but paid before the next regular billing cycle, even if that billing date and payment date is after the end of your covered period. So the example right in the May 22nd guidance is the covered period begins on June 1st and ends on July 26th. The borrower pays 2 bills during those 8 weeks, 2 electric bills, one for May and one for June. They also pay a July bill on August 10th. So in this example, they're entitled to claim for forgiveness the entire amount of the May bill, the June bill, and the July bill for services up to July 26th, even though it was not paid until after the end of their covered period, let's say August 10th or 11th, but before the next billing cycle. So they want you to be timely and make sure you're staying current with your bills, but they will give you the benefit of doubt. The next significant pot is rent. Okay, and these are rent or lease payments obligated under a lease agreement that existed before February 15, 2020. So again, it's not doesn't have to be a long-term lease. It could be a month-to-month lease as long as that agreement was in existence before February 15th. And you also include rent on real estate and personal property. So the personal property definition expands greatly the various lease payments that might be available to recover. So if you have truck leases, those should be able to be recoverable. Copier leases, postage meters, all your various lease of personal property should qualify. Also, let's say you're a contractor and you're renting a piece of equipment for 6 months, and that piece of equipment started to be rented prior to February 15th, and you continue to rent that over this covered period, those should also qualify for forgiveness. The next pot is utilities. And again, the easy ones are electricity, gas, and water. We all understand what those bills are. Telephone, I'm going to skip over transportation. Telephone, and again, this is cell phones and regular landlines that were paid by the company prior to February 15th. So as part of the application process, you must submit an example invoice where you've been paying these utilities prior to February 15th, and that you're just going to include these covered amounts for the covered period in your forgiveness application. The other one is internet access. That should qualify. And the last one that, again, we're still looking for some guidance. There's not been a lot of guidance, is in the area of transportation. So the only real solid guidance we've found to date is some guidance issued by the SBA to small PPP borrowers. These are the sole proprietors and self-employed individuals. And in that guidance that the SBA has released, they reference transportation. And the example they give for transportation is fuel used for your trucks. And so it appears like fuel costs and other costs necessary for your equipment to operate them. Of course, gas and electricity are already been included, but fuel of any sort should qualify for this forgiveness portion. Again, you have to demonstrate that you were buying the same type of fuel prior to February 15th, 2020. And the last of the three non-payroll buckets is mortgage obligations. The first has to be a liability of the borrower, so it has to be a loan where the PPP borrower is at risk. It also has to be secured with a mortgage on real estate or personal property. So again, these are not just mortgages on real estate. It's also like equipment loans, truck loans, anything tied to personal property. The debt had to be entered into and documented prior to February 15, 2020. And under a new guidance, they came out and said, no, they will not permit advance payment of interest on eligible forgiveness. So there was some questions and answers, or some, I think, inquiries of, can I prepay my interest? And the answer to that is no. So then here's an example over the 8 weeks to add up your 3 pots of money, or 3 non-payroll cost areas. First one's rent. Here in this example is 85. You got utilities of 101 and interest on covered mortgages of 6. So in this example, the non-payroll cost totaled $192,000. However, based upon their payroll cost, the maximum they can deduct and keep this at 25% of the total forgiveness is $175,000. So while they got $192,000 available costs, they can only use $175,000 for the non-payroll cost area. So now that's how you calculate all the costs eligible for forgiveness. And so the next step of the forgiveness process is that amount to be forgiven can be reduced due to two tests, and these are either or. It's not one or the other, it can be both. And so there's a full-time equivalent test that we're going to go through that basically measures whether or not you're maintaining the same number of full-time equivalents you had last year at the same time or right before the pandemic, as to compare to how many full-time equivalents you had during the 8-week forgiveness period, and also one on salary or wage reduction of more than 25%. So through the last 2 months, I've been talking to a lot of clients, and I've not had a single client or customer that I know of or company I've talked to that's been able to reduce someone's salary. Usually to get them to come back, you got to offer them equal, if not more salary in today's economy. And so I don't see that being a huge issue, but it could still be an issue. So under this new guidance that came out last Friday, they made it clear that you will not get double penalized. So you can't get hit for both a full-time equivalent reduction and a salary wage reduction if both happen. You're only going to get hit with the wages that go beyond the full FTE reduction. So the example they give in the guidance is you have an employee that usually works 40 hours. Because of the slowdown business, you can only offer them 20 hours. But you continue to pay them at the same pay rate. So their pay rate stays the same. So their total take-home pay goes down, but their pay rate stays the same. In this case, you will only be charged with the FTE reduction. There will not be any wage or salary reduction for this individual. So how do you calculate the FTE reductions? There's 2 look-back periods. So the first one is last year, 19, the period of February 15th to June 30th. Calculate your FTEs for that period. And the other one is the period right before the pandemic, so January 1st through February 29th of 2020. You calculate the FTEs, and you use the lower of those two. The FTE calculations is based upon 40 hours. I know there was some talk about it being a 30-hour. There are other portions of the CARES Act that reference a 30-hour, but the SBA in their guidance debated that and decided to go with a 40-hour calculation. If you are using the alternate payroll period that we previously discussed, you must also use that in calculating your FTE reduction determination. And so when you're doing your FTEs, no one's counted more than one. So if someone works 44 hours, they're just counted as one FTE. And for those under the 40 hours, you have 2 ways of calculating it. You can calculate to the nearest 10th of an hour, or each employee under 40 is counted as a half an FTE. And you use the same calculation for the 8 weeks and the two look back periods. You would use the same calculation. So here's our example. In this example, this company had 32 FTEs during the 8-week forgiveness period. In 2019, they had 41. Right before the pandemic, they had 38. So we take the lesser of the two, which is 38. So they're down 6 FTEs. So the amount of forgiveness will be reduced by 15.79%. Now, there are 2 safe harbors that have been talked about and are included in various guidance. Some of this is in the latest guidance and some of this in the application process. The first one is restoring. So you are given a safe harbor exemption if you restore your FTEs in the previous calculation back to, like we said, 38, back to 38 by June 30th. You have no reduction for FTEs then if you do that. Also, we've heard from a lot of companies we spoke with that while they're asking their employees to come back, they're deciding not to. They're worried about their health, they're worried about the health of their family, and they're refusing to come back to work. So you get to count them as an FTE, even though they refuse to come back. If you offer them in writing to come back and they reject, or any employee during the covered period you fired for cause, resigned, or request and receive a reduction of the hours, you do not get penalized for any of those situations. In that written offer, you need to make it the same pay rate and for the same number of hours they earned during their last pay rate before their last payroll, right before they got before they were furloughed or released. And also, to claim this exemption, you must notify the state unemployment office that you've offered this individual the job back. So again, there's two nice areas here to correct this FTEs to maybe restore so you're not getting penalized for reduction in FTEs. The last one is also reduction based upon compensation. Again, this is not affected by any FTE reductions, just pure compensation reductions. Again, this can also be eliminated if you restore that salary or average wages back to what they had prior to the pandemic by June 30th of 2020. And again, what you look at is, was the reduction greater than 25%? And if that reduction was greater than 25%, that additional excess amount, in this example, 8%, needs to be a reduction in the amount of forgiveness you're going to receive. So here is the final calculation based upon the information we just looked at. In this example, this company got a PPP loan at the very top of $700,000. They have payroll costs of $525 and non-payroll costs, which is limited at the 25% to $175. So they have exactly $700,000 of forgivable cost. However, because they had the FTE reductions, they forfeit $110,000 of that forgiveness, and also they had a small salary reduction of $6,000. So the maximum amount available for forgiveness is $583,224 in this example. And the remaining loan of $116,776 will now be amortized at 2 years at 1%. So, it's still a very favorable loan situation. Again, there's been talk in Congress. There's been pushback on a couple areas. One of the areas is the length of the loan. When they first wrote the CARES Act, it could have gone up to 10 years. The SBA guidance through with the Treasury came back with a 2-year repayment. There has been some discussion of extending that to a 5-year repayment, but right now still a 2-year repayment term. Okay. Other items to note in this forgiveness process: if you had an economic disaster loan prior to April 31st, a portion of your loan will not be available for forgiveness. Again, conditional guidance continues to come out. The Q&As come out throughout the week, and then every Friday, it seems over the last couple of Fridays, we got a new tranche of guidance. They have labeled the rule, I believe, on May 22nd as the final interim rules, but they still leave the door open for additional guidance. When we go through the forgiveness process, the SBA will have final say on forgiveness. So again, they will have the final say. And two other things Congress is considering, because they pushed back pretty hard on this, was there's this 8-week forgiveness period. I know Trump had a meeting with representatives from the restaurant lobbyist group, who is really struggling with this 8-week forgiveness simply because they're not getting the payroll. They're paying the rent, they're paying the utilities, but unfortunately they've been totally shut down or greatly shut down. And so they're not be able to use the payroll, and so it's really minimizing the amount of their loan forgiveness. So they're looking at 2 ways to correct this, and it might apply to everyone. It might just apply to restaurant industry. Not sure where it's all going, but expanding the 8-week forgiveness period beyond the 8 weeks, or eliminating, or maybe both, that 25% maximum on non-payroll costs. So that's the SBA guidance. And so there are certain sections of the law that impact the IRS, and so they have issued some guidance. So really, in the CARES Act, when Congress passed this, they intended not only to allow companies to have this loan forgiven if they pushed the money back out of their company back in the economy and kept the economy liquidity going in the economy, that they would get a second benefit, in this forgiveness loan income, which is like income on your financial statements, would not be taxable. On April 30th, 2020, the IRS ruled that they agreed with Congress and the CARES Act that this income is not taxable. However, they went on to say that while these proceeds from these PPP loans will not be taxable income, any deductions financed or paid for through the forgiveness are not tax deductible. So basically taking the tax deduction away. Again, Congress has said they don't agree with this position. They're trying to correct this to the IRS. And if unsuccessful, they might change it in a coming up correction act. So how do you do forgiveness? There's an application out that came out May 15th. It's SBA forgiveness application form number 3508. It's pretty, it's 2 pages, I think 2 or 3 pages long. It asks for these various costs that we just went through and the various reductions calculations. Once you complete this, you submit it with supporting documentation to your bank. They're going to want to see both invoices or supporting expense amounts, plus the fact verification that you paid these various expenses. And then also for anything that need to be in place prior to February 15th, they're going to want to see rental agreements and various items like that. If you look at page 10 of the application, it explains what's necessary for each level of cost for payroll costs and non-payroll costs. So once you submit your application, the bank has 60 days to review it, and they issue the initial decision. They decide whether or not you've met the definition of the required documentation and items in the application, and then forward that on to the SBA. So they do like a pre-review, and then the SBA has 90 days to agree or disagree and remit the amount back to the lender for the amount forgiven. So they pay off that forgiven portion of the loan. And so then it's basically written off your financial statements. You know, the documentations must be retained for 6 years. So that's a key part of that. So a couple areas to talk about the CARES Act before we open up with questions. I'll try to get through as quickly as possible. Just the employee retention credit, there is this out there. Again, if you decide to use the PPP program, you can only use this for the period up to the date of forgiveness. So for basically an 8-week period, you can also do the employee retention credit. And again, in this program, you have to demonstrate that you have had financial impact to your financial statements. And it's a credit against your FICA tax. And there's one set of rules if you have more than 100 employees, and another set of rules less than 100 employees. And they also, under one of the guidances, that if there's companies under common ownership, you have to aggregate those together to come with the greater than or less than 100 employees. Okay, who qualifies? You're either suspended or partially suspended from operations due to government authority, due to the pandemic, or experience a greater than 50% reduction in gross receipts as compared to the same quarter last year. It is available to exempt organizations. Most governmental employers are not, and an employer is not eligible if it's obtaining a PPP loan except for the period up until the date of forgiveness. So we're talking about an 8-week period there. Again, testing the gross receipts compared to last quarter, same time, more than 50%, you start qualifying for the credit. And once you grow to 80% of test, the credit stops. How do you apply for it? The credit period started on March 13th, so that was almost towards the end of the first quarter through December 31st of 2020. It is a refundable credit. The first time you can claim any of these credits are on the second quarter 941. So any credits you earn for that last week or 2 weeks of March, March 13th or 31st, you will claim on your second quarter 941. And if you get a refundable piece, you claim for that refund on Form 7200. There is this last thing about delayed payment of taxes. Also, if you participate in these tax credits, again, You get to defer your taxes, your FICA tax for all of this year and pay it back over the next 2 years. And again, if you're getting a PPP loan, you're going to use this for the 8-week period up until you get forgiveness. Real quick, economic disaster injury loans. This is a program that's available for traditional small businesses. So it has the standard SBA rules for determination, not the less than 500 employee rule. Because of the pandemic, all 50 states have been declared an economic disaster, so they all qualify. You can use this loan and get a PPP loan. However, you got to be real careful because they both are funding the same cost. And so if there is cost funded like payroll, while you have both access to a PPP loan and an economic disaster loan, the SBA could take the position that the economic disaster loan paid those costs. And so you forfeit your forgiveness under the PPP program. So we're recommending to companies be careful with this and make sure they get beyond the 8-week period. You can still apply. Congress just allocated another $50 billion to this program. This program's been around for a long time. This program's not going away. So again, you can always apply. As part of that program, if you do qualify, they're going to give you an automatic $10,000 grant, economic disaster grant. Again, you have to demonstrate that you've been economically harmed. Again, it's usually that same revenue testing, and they can provide up to $2 million in relief. I'm starting to lose my voice here. The interest rate on these will not be greater than 4%. You have 30 years to repay them. Again, you do have to, demonstrate that you can't get credit elsewhere. So this follows the traditional loan, SBA loan rules. So here's our decision tree, the 2 loan programs, paycheck protection or economic disaster. Decide which tree you'd like to go down first. Most of the people we're talking to are doing a paycheck protection program. So maximum $10 million loan, 2-year repayment term and 1%. You apply to your financial institution, your banks for this. The economic injury disaster loan, maximum loan is $2 million, term is 30 years with interest rate at 3.75. We just had a company we know get quoted that, and you apply directly with your SBA. Again, under the economic injury disaster loan, those terms could change. And then employee retention credit, you have to decide between paycheck protection or the employee retention credit. Again, that's $10,000 per employee retained. And that employee retention credit can also be used with economic injury disaster loans if you would like to borrow some money. And finally, last slide here, and then we'll open up for questions. There are 2 state programs available to us during this pandemic. The first one is the Bureau of Workers' Comp has suspended payments for March, April, May, and they're going to provide a $1.6 billion dividend to employers, which I think already start coming out. And this is a 100% return of all 2018 premiums paid by businesses. And there's another program that's been around for years. I don't think it's widely used, called Shared Work Ohio, and most other major states have the same program. Michigan has a similar program. It's a voluntary layoff aversion program. Again, the idea is so you don't lay off everyone, you retain your employees, and during times of reduced business activity. So what you do, you negotiate for all your employees, like you're going to reduce the number of hours they're going to work by 40%. So you're going to pay them 60%. And then the State of Ohio Unemployment Office will make up the difference through unemployment insurance benefits for the other 40%. And again, it's not 100% up to the other 40%, but it gets them probably back to 85 to 90% of what they're making. And again, by using this program, it is not claimed as an unemployment benefit against your company. So you do get to avoid that. Again, there's a link to that program. So we have about 10 minutes left here. So I'd like to open it up for questions.
All right, and we did get a couple questions in here, Bob. One thing I would mention, I'm glad to see you mentioned the shared work program. One of the other pieces of that is that as I understand it from what I've read about it, employees could still be eligible for that $600 federal payment in addition to the amount of the state unemployment insurance as well. And so that's good for the employees in that case. And again, that doesn't count against the employer there either. So that is something that probably should be used more by many employers.
Exactly.
Yeah. So, and then the other thing that caught my ear while you were talking was, you were saying that you have to be careful about the what you can claim if you have that economic disaster loan. It's the other place where there's some interaction with one of the prior laws, the Families First Coronavirus Response Act. There's payments in there that companies can take tax credits for if their employees qualify for going on leaves. And again, correct me if I'm wrong, but my understanding of that is that if they pay those employees for taking that leave, that they can't claim that as part of the payroll protection program funding or the loan forgiveness there.
I believe you're right.
Yes, yeah, that's been my understanding. So, okay, a couple questions, and some of these I think you did answer as we were as you were going through there. But this one actually came in a while ago. First part of the question was, are contract 1099 employees covered as part of the payroll protection program?
Well, they are, but not as your employees. So
Right.
if you're paying someone the 1099, that's not wages. It's only W-2 wages that you get to claim for payroll costs. The logic behind that is that they're entitled to apply for their own PPP loan because they're, in theory, a self-employed individual, have their own business. They should be applying for their own loan.
Yep. Okay, good. And this one, I know you definitely answered, can we pay employee bonuses to help spend down the balance? And you did indicate that, yes, companies can do that.
Now, a lot of people are calling it hazard pay because there is a lot of concern. You know, some employees are concerned of coming back to work and maybe being exposed. So it makes logical sense to pay them a premium maybe during this pandemic.
Yep. Okay. Question is, are payroll companies' fees allowable as part of the loan forgiveness?
No.
I don't think so.
No.
Yeah. And are state taxes covered? And you indicated that yes, they are in that
Well,
case.
only state unemployment. So I mean, I think where the confusion comes from, you know, a lot of companies withhold and pay state and local withholding tax. That is not the company's tax. That's the employee's tax. None of those qualify for forgiveness.
Yeah.
Only expenses of the company.
Okay. So here's another question that was asked during the presentation. And you mentioned a little bit about this also. If you select an alternative covered period for payroll cost, does that period also apply to non-payroll costs, or do you have to stay within the covered period for non-payroll costs?
No, it only covers for payroll costs. And it's very clear in the guidance what areas cover the alternate period. They labeled it alternate period or covered period.
Okay.
And all non-payroll are considered covered period only.
Okay. All right. Yeah, that would have been my thought process there also. But and then there's one here that I think actually does apply more to the Families First Coronavirus Response Act. But let me ask you this, and perhaps between the two of us, we can give a good answer here. Question, let's see. With the PPP loan, since we paid an employee for over 100 hours that he did not actually work, but it was at home due to COVID, and is now back to work and needs to be off now due to COVID again, due to his wife being sick, do we have to continue paying him 100% or 2/3, or have we met our obligation for him?
It really depends on when that covered period started for them. Did they make it to the covered period before he left?
Yeah. And I think it also gets back to what I mentioned just a minute ago also. If they paid him during that time, and they're going to take the tax credits for the Families First Coronavirus Response Act, then no, that would not be covered. Right. In terms of how much time he's going to be off, again, according to the Families First Coronavirus Act, if he was paid for 100 hours there of that, they're not going to need to provide anything more than that under the FFCRA, because the maximum there is 2 weeks pay as part of emergency paid sick leave. So I could follow up more with that person.
Yeah, that'd be great.
Yeah. Let's see. I think we had another one. Well, yeah, we do here. Recent guidance from the SBA talks about the SBA reviewing borrower eligibility, including calculating the loan amount correctly. If the loan application was pending on April 24th, when the SBA released guidance on how to calculate the loan amount for self-employed, and it was later discovered that the loan dispersed was more than they would have been eligible for based upon the updated guidance, then A, can the business still receive forgiveness for the full amount, provided they have eligible expenses, or are they limited to receiving forgiveness on the corrected borrowing eligibility and calculation?
Yeah, that's a gray area. There's no guidance at all. I've had this question asked of us a few times. We've all concluded probably the best thing is that you only get forgiveness up to the amount of the correct loan calculation.
Okay.
And the remaining amount is either paid back or paid back over 2 years.
Okay. All right. And then also regarding that same situation, is the business required to repay any excess disbursement, corrected borrowing calculation, minus the actual loan disbursement that is not forgiven at the time of the forgiveness request, or are they eligible to use the 2-year 1% repayment loan terms for the balance?
I don't think there's any guidance. And again, it looks like even an example they give in the recent guidance, if you're deemed that you were not meeting the certification and you're over the 2 million, they're making questioning about your certification of necessity, that you still get the 2 years to repay the loan.
Okay.
That you must not pay it back immediately. So.
Okay. All right. So here's another question. For the wage and salary reduction safe harbor, do the requirements to eliminate the reductions in salaries and wages require employers to distribute additional pay to catch up the employees' reduction in excess of 25% by June 30th, or simply to have those employees back at their full hourly or salary rate by June 30th?
That's a good question. I don't know the definitive answer there. I can see both logics. Again, this has to be prorated too for the 8 weeks. So every time we see this calculation, it's not a huge number per employee. So again, I would err on the side of conservatism and suggest that, it has to be caught up for the 8-week period.
Okay. All right. All right. Last one that I have here then, for the FTE safe harbor, assuming the company has reduced staff during the 8 weeks, but returns their FTE count to the same or higher than that test period by June 30th, does it have any effect on their forgiveness if staffing levels drop back below the test period later at the end of July or August?
No, okay. They met the definition, they're safe harbored, no reduction.
Okay. Okay, great. All right, let me double check here to see if there are any other questions that came in. Terry, I think you're probably listening. Did you have any other questions that came up that I don't see on here right now?
Oh, we actually did have quite a few come in,
Okay.
And we can definitely go through those and then send out a full
Okay.
I can answer any questions later on too. I know we've been on almost an hour now, so we want to be sensitive of everyone's time.
Exactly. Yeah. Well, this has been great, Bob. I know that I learned a lot during this time here. You made it understandable even for an HR guy here, so I appreciate that. I appreciate the cooperation, the partnership with Gilmore, Jason, Mahler here to be able to put this thing on. And who knows, if another law is passed, we may need to do another one of these things.
That's fine. We're ready to go.
So I appreciate you. Thank you very much for your time, and thank you everyone for joining us. I know at one point in here, I think we had about 380 people or so that were on here with us. So,
excellent.
So appreciate everybody joining us for this, and have a great afternoon.
Yeah, take care, everyone.
Thank you.
Bye-bye.